Welcome to the Virtual CPA Success Show, where we're 100% focused on helping service-based businesses achieve success. Are you a business owner interested in learning how to scale your business? Has your business reached over $1 million in annual revenue? Then this podcast is for you.
Welcome to episode 6. I am joined once again by Jody Grunden, the CEO here at Summit, and we're going to answer everybody's favorite question. How much money should I be making if I'm working at a digital agency? How much money should my company bring in? So, Jody, I'm just going to throw that right at you. Let's start right away with that first answer. How much money should I make if I'm an agency?
A ton is the answer. A ton of money. So it's basically any service-based company in general should be making at a bare minimum 15% net income. And we say 10% net income is kind of our break-even point. So anything south of 10%, and this is annualized, obviously each month's going to be treated a little differently, but on an annualized trending, you should be, a 12-month trending, you should be making as a service-based business no less than 10%. You should be targeting at a minimum 15%, and the really successful agencies are making 25% or greater. So it really depends on a lot of things in your company, a lot of things that will trend to that. But I say make as much as you can. That's the key there. Net income is high, and you can build cash easy.
Great. So in your book, and in case anyone hasn't seen Jody's book, Jody has an awesome book out there. So make sure you look that up. The link will be in the show notes. But in your book, you talk about 10% being the new break even. So Can you go into that a little bit and what exactly that means? Yeah,
sure. So 10%, we call it a break even because, like I said, if you're not making at least 10%, it's really hard to manage cash. Cash flows up and down all the time. You need that 10% really to come in, and to help you do that. Because keeping in mind 10%, well, 40% typically of that 10% is going to go to the IRS, and so it really only leaves you 6% or 60% left. So 60% of 10%, is really all you have to build cash. And so if your goals are pretty high, that hey, you think, we got this building that we want to purchase or this down payment on this big thing, this big new hire, and you're making less than 10%, it really starts getting into risky waters. So that's why we say 10% is kind of a break even. You want to make at least that. The higher you make over and above that, the more that you can do fun things with.
And we'll get into the categories here in a second, but one of the things I want to point out here is oftentimes the smaller the company, the higher the profit margin, the net profit margin at the bottom. And a lot of the reasons is because there's just less overhead cost spending, and it's a little bit easier to make that higher profit. So oftentimes we see companies coming in with 8, 9 employees making 25, 30, 35% as they scale, and as they get bigger, those amounts go down, and they're like, what's going on? And oftentimes we'll have to have that conversation is like, well, you just had to hire a new marketing person, and you had to do this and you had to do that. So that's one of the things I definitely wanted to make sure people are aware as our listeners. If you're at that small size company and you're making much higher numbers than this and you plan on growing, just expect those numbers to be a little bit lower the bigger you get.
Yeah, for sure. Because once you hit that $1 million mark, you really start becoming, where you are the producer or predominantly producer, you really have to kind of roll back your sleeves a little bit. And now you become more the non-billable type personality. And then as you get even bigger, then you'll have to hire, again, the other people, the marketing person, the COO, the CEO, all the different people that you need to manage that company. And that's why Jamie's saying your profit margins will get smaller, and they do. So the fact is that, like I said, 15% is what you need to be making. I'm talking about a company over $1 million. If you're less, you probably should be targeting more towards 30% as a good benchmark for you.
And when we say less, and I want to make sure this is clear, we're talking about percentages here. So we're always talking percentages. So your dollar amount should go up. Your net income dollars coming back into the company should go higher, but the percentages are getting lower. So.
Yeah, for sure.
Great. So one of the things that I like that Summit does is we try to simplify the income statement. And so that's what we're going to go through throughout this podcast, is kind of go through the sections of the income statement and why they're important and how they're calculated. And then at the end, we're kind of talk about how we can improve those areas. So let's start with the top. So we talked about net income being on the bottom. At the top of the line is obviously revenue. And then right below there, you take out your production costs to get gross profit. So if I want to be a 15% profit company, where should my gross profit be? And how do I make up my gross profit?
Okay, so it's important to understand what production expenses really are, first of all. So with production expenses, it's similar to a manufacturing company, but in a service-based business, it's called cost of sales. And your cost of sales are basically the employees that are used in the production. So this is what we're talking about. When we talk about that, are basically the producers, the project managers, the account managers, everybody that's the designers, everybody that's in that top end bucket should be in that one. So that your office manager, your marketing person, your sales, your business development person, a lot of times the owners are going to fall outside of that and they're going to be below the line, which we call below our gross profit margin. So it's important to understand, hey, we've got those salaries in there. So if your average salary is whatever, and you're gonna, well, not even your average salary, so whatever your accumulation of all your salaries would be there, and plus any direct costs related to that individual. And by the direct cost, we typically call that burden costs. And the burden costs that we define are just simply those that are direct burden costs. So we don't look at the indirect burden costs. So burden costs would be like your payroll taxes, your 401k match, your health insurance, disability insurance. If you have, you've got to allocate the amount of money that you spend on their equipment, through technology. So it could be a direct technology stipend, which are very easy to manage, giving your employees, a $2,000 a year technology stipend so they can upgrade their equipment whenever. Or if you don't go that route, but you actually supply the equipment, then you need to put that above the line so that your depreciation for those in accounting terms is going to be within that cost. So that's important. Others would be like your education. They always say if you're not educating your employees, the next employer will. And so the key there is to keep your people, make them smarter, make them produce, make them more efficient. And so we also would include your educational stuff up there too. So if you're sending them to conferences like a DrupalCon or something like that, that's going to be above the line in the production cost, which is really important to understand when you're comparing apples to apples. So in addition to the actual employees, the other, I'd say soft expenses would be kind of like your software expenses that are directly related to production. So if you've got specific software that you use that are production-based software, then you want to include those above the line as well. So things like Slack and GoToMeeting or Zoom or stuff like that, that's going to be below the line. But if you're using something more towards your clients, then you're going to want that being above the line as well. And so once you've done all that and you're looking at your total expenses that we call, again, production expenses, subtract your revenue from that, and it should be roughly 50% of your total revenue is what we typically see in a successful company. When it gets north of 50%, then the one thing it's going to hit is your bottom line, and that's going to hit, that's going to shrink your net income. If it's higher than that, then those are the companies that we're going to see that your gross profit is going to be higher, which again will also trace right down to your net income. So it's important to have that 50% or greater as a good benchmark, and that's typically what we see with our clients is right around 50%.
So Jody, how do I handle the employee that does two things? So I have the guy that's a producer, but I also is a really good salesperson, so I have him below the line as well. How would I handle his costs or her costs?
So if there's a distinct distinction between the two, like let's say like you're saying a producer and a salesperson, I would typically take 50% of that person's salary, and that would be above the line, and then 50% would be below the line. And the same goes with like the owners, because a lot of times the owners are, especially when you're in that $1 million mark where they wear several different hats, you kind of have to bifurcate their salary also, so that part of it goes up above the line in production if they're still doing production. In marketing, typically we see a lot of owners in the business development or the sales and marketing bucket, and then other owners might be partly in the admin. So you have to technically divide it into all three areas to give a good comparison when you're comparing company to company, or really kind of seeing how well you're doing. Because what the problem is that if you're producers, if you're a producer and you're an owner and you're up in the top part or you're not in the top part, it's going to distort your numbers and look like, my numbers are doing really well there. And then you look down below line, it's like, well, my sales and marketing is kind of blown up, or my admin's blown up, or vice versa, where you've got everything above the line, nothing below the line. You're like, oh, well, I'm doing great. I don't have hardly any kind of marketing expense. When you find out that the owner is actually the one that's doing it, and the majority of their salary, his or her salary should be in that bucket, it distorts that as well. So it's important to bifurcate it. Now, I wouldn't get so granular to separate that out on a weekly basis, or to, I wouldn't go through that pain unless you want to hire a bunch of accountants to actually do that for you, because that does get kind of, it doesn't give you a whole lot of benefit. But just taking generalities, if you take the last 6 months and kind of, what have they been doing the last 6 months or over the last year, and that'll give you kind of an idea. And then just simply break it out through journal entries into the to the different buckets.
And you can also look at what you hired them for. Like, again, it doesn't really matter where they're putting those hours, but if I'm hiring someone to be 50% production and 50% marketing, that's a great way just to split those costs. And because some weeks they may be a little bit heavy towards one side versus the other, but I think it's just important to have it consistent along the line. And again, the reason we do this is because we want to be consistent with other companies. Oftentimes we'll go to events and we'll talk to 5 different companies and everybody will tell us their gross profit. And someone will say, oh, I'm a 70% gross profit. And someone will also say, oh, I'm only 40, but then I look at their bottom line and they're exactly the same. They're both around 15%. And a lot of times it's just because of the way they're allocating these costs. And so we really want to make sure when those two companies are talking to each other that they're talking about the same thing. And that's why with all of our clients, we make sure to get them consistent. So when we're comparing them, it's easy to say, oh, this is where you need to improve. This is the areas to get better.
Yeah, and keeping in mind when you're comparing against another company, that doesn't necessarily mean you're doing better or worse than that company, because you really have to compare against yourself and what your forecasted vision was supposed to be. So when you forecasted all your numbers out for the year and you thought, well, by the end of the year we should be at 50%, and we're at not in reality right now we're at 45%. Well, it really doesn't care. It doesn't make a difference what anybody else is doing. You're comparing against yourself and what your vision is. So it's important to understand what everybody else is doing, and like Jamie's point, so that you have a good idea if something's going wrong. You can kind of look back and say, oh, maybe it's in marketing because we're spending too much there. Maybe it's in facility, or maybe it's in admin. We can trim a little bit there, or maybe it's in production, which is where it's at 90% of the time. You can look at that and kind of tell, but the biggest thing is to compare against yourself and your own goals first, and then go to the industry second as a solution to, or trying to figure out where you're going wrong.
No, that's a great point. And I think just looking at that bottom line, 15%, if you have 15% net income, that means you have 85% cost. Where those 85% falls is up to you. It really is just matters on how you want to run your company. And so that's always how I've looked at it is, this is your bucket to play with. This is your salary cap. This is how much you can spend. You might decide to spend all of it in marketing and only have 2 producers. And as long as you're still hitting that 15%, more power to you, whatever it takes to get there. So
yeah. And it also depends on what type of business you want to run. Are you running it so that it's more of a job, where it's something that you can walk away with and it's not worth anything when you're done? Or do you want to build a company bigger than yourself where you can actually sell it someday? So that's also going to play a big factor into it. You may want to take all that burden yourself and be a workaholic and work your butt off and be the biggest producer in your company, and your gross profit is way high, your net income is 30-40%, and you're like, I'm making better than you are. But guess what? When it comes time to sell, you're not going to be able to sell for anything. Whereas the person maybe taking a lesser net income, maybe they're 25%, 20%, they're removing themselves out of the business. And when they go to sell it, guess what? It's going to be worth a pretty good multiple, because they're no longer the big influencer in the business. They've made themselves irrelevant, which is really important.
That's another great point. Yeah, it just depends what your long-term goals are. And that's a lot of the ways to look at this and how you set up your business. So that's great. So before we get to the overhead, one thing you talked about a little bit earlier was burden. And I just wanted to make sure that our listeners get an understanding of that. What do we normally see for burden as a percentage of an employee? So just to kind of put it in simple terms, if I'm paying my average employee $100,000, how much do we normally see in terms of burden costs on top of that?
And burden costs, the percentage is going to scale based on the dollar amount of the employee. Obviously, the higher employee, the less burden, less percentage, depending upon the dollar amount. But we typically see, I'd say, between around 25-ish%. Is that pretty much what you're seeing?
That's what I've been seeing as well. Yep.
Yeah, so 25%. And again, we don't get as granular as to take a percentage of their desk, a percentage of utilities, a percentage of this and that. We only take the direct cost related to that employee that you can, the variable, basically your variable cost. Everything else we're going to slide into the different buckets to make it easier to read. I talked with an accountant that worked for another firm, worked for a client. And what she was doing is she was really breaking it out so granular that she knew exactly the percentage of floor space that, every person had. And for a service-based company, that's really, really not necessary. If you know what your percentages are below the line, you can get that same information. The problem is it took, basically a full person to do all that calculation and do everything. And it really didn't give them really any more information that they can make an informed decision with. So it's important not to get too granular, I guess. Stay as high as you can at the higher level, just knowing that, hey, that gross profit, that first one we talked about, it's got to be roughly 50%. We told you everything that goes in there. The bottom line's got to be roughly 15 to 25%. The rest is your overhead. And I think Jamie, that's where you're getting into next.
Yeah. So let's go there. Let's go into overhead. So if I'm spending, 50% of my revenue on production, what is that other part? What is the overhead? And I know there's 3 categories there. So let's just start with the first one, which I think is probably the most difficult to put your hands around and how much to spend. But let's talk about sales and marketing. So how much is there?
So to kind of get into those 3 buckets. So the overhead's made up of 3 buckets. We call it your admin bucket, your marketing bucket, and then your facility bucket. And so each bucket is in its own. You should have the employees within those buckets. So obviously facility is not going to have employees typically in it. So you're looking more or less for the employees to be in the sales and marketing and also in the admin bucket. So this would be, in the sales and marketing, you're going to include all the conferences that you're going to as a business development type conference. You're going to include the salary for the salesperson, a salary for the marketing person. If the owner's part of that group, the owner's part of the owner's salary, if not all their salary will be in there, and any kind of dues, subscriptions that are going to belong in there. Typically, we see about 9% of our revenue goes towards sales and marketing. And that's going to vary dramatically based upon the reoccurring revenue that company has. So keeping in mind that if a company has a very high reoccurring revenue model where they don't have to replace everything as often, well, then that percentage will go down typically. If they've got a low reoccurring revenue model where they're out there hunting for the next client and they have to replace the client as soon as one leaves, and that's how they make their money because they don't have a reoccurring revenue, then typically you're going to see it closer to the higher level of 9, maybe even 10, 11%. So it's really going to vary a little bit upon the structure and the makeup of their company and the type of model they have. But if they're up 20, 30%, there's something wrong. They need to figure out what's wrong because that will eat into their bottom line pretty quickly. And it's typically a salesperson's not selling or the marketing's not driving enough business to it, and maybe the marketing's in the wrong bucket and should be focusing in a different area.
No, I think the great point there is, especially on the marketing one, admin and facility are a little bit different, but marketing is meant to generate revenue. So if you have a 20% marketing cost, then the question to the marketing team is why aren't you generating more revenue, or what can we do to generate more revenue on that side? Because, if you have too much marketing costs, then they're not paying for themselves, which they really should be doing.
Oh, for sure. And then the easy bucket to talk outside of sales and marketing would be facility, because that's kind of the pretty basic one. That really is going to be the lease payment. If you're leasing, if you're renting, it's going to be your interest on your mortgage, or if you own it, it's going to be interest on your mortgage. The utilities that are involved, trash pickup, everything that's that's associated with a brick and mortar company. We typically see that being about 3.5% to 4% is what we see. And that's pretty much how it is. Kind of weird. That's pretty much how it is all across the nation. We don't see it really big, huge spikes in New York or San Francisco like you would think, because typically your revenue is a little bit higher in those. So when it all falls off as a percentage, the dollar amount's a lot bigger, but usually the revenue is too. So as a percentage, though, it's typically relatively the same amount there.
So for Jody, so what about distributed companies? So if I'm a distributed company, can I just assume I'm going to be 4% profitable than everybody else, or will I make up for those costs?
Pretty much. You won't have anything in that bucket, but you'll have more in the admin bucket, because the admin bucket's the last bucket that we're going to talk about, and that's going to include different kind of like company retreats. And so, like for instance, a distributed company, you may not see 3 to 4%. It probably won't be that high. Well, it depends on again how big the company is, of course, but. With that, and it also depends on how many retreats that the company does. But a typical distributed company will have about 2 retreats a year. One retreat's typically a company-wide retreat. The other retreat's typically an departmental retreat where they're getting together and kind of sharing things on a more of a personal basis, getting to know each other a little bit more on a personal basis, which is important for distributed team members. And so that cost is going to typically be in the admin side. And so what else goes in the admin side? Well, your office manager, receptionist. If you don't use a receptionist, but you're using a third party like a Ruby receptionist or something like that, the contract cost will go up there. Any kind of fee that's associated with the day-to-day stuff, your mail, your dues, subscriptions, anything that's not related specifically to production or that's not related specifically to marketing kind of goes into that bucket there. And so the key to that bucket there is you don't want all 3 of them as an accumulation to grow greater than 35%. So it's kind of like your slush bucket, or your default, what doesn't go into facility and what doesn't go into marketing. ends up going to admin. And that, again, you don't want it to be greater than 35%. Now, the better you get and the more that you can scale a recurring revenue, that as a percentage will start going down. The dollar amount doesn't change a ton, which is kind of cool with the admin side, because most of your change is going to happen with the people side at the top on the production side as a percentage. So you should typically see a flat admin, maybe a growing dollar amount for the marketing. Facility costs will typically get a little bit lower, maybe equal as a percentage as you get bigger and your company starts to scale.
Great. Okay, so we've done the math to back into that 15%. So just to summarize, so the 50% gross profit, 35% total overhead gets you to 15%. Obviously, improvements you can make in either area will get you over that 15%. So if you're a low overhead company, you might get to 25%. If you're a really efficient producing company, you could get your gross profit up to 60%. But both of those will fall to that bottom line to improve that 15%. So let's talk a little bit about those improvements. So I'm a listener to this podcast. I just paused it and I went and did the math, and I'm at 10% net income. What can I do, Jody, to bring that number up? Any tips for me?
Yeah, outside hiring a firm like us to help you out. Just joking there. But anyways, a big tip would be I would first of all look into the software expense, because a lot of times we find that software is a place that a lot of the unnecessary expenses will hide. And what I mean by that, it could be that you're paying for a software that you thought was a great idea a year ago, but really aren't using today. It happens quite often. Or maybe the users that you're paying for, maybe you've gone down in a number of employees, over the last year, and you're still paying for 50 and your employees are not 40. There's 10 seats on there that you could probably scale back on a little bit. So software is one that I look at right away, because typically it's the low hanging fruit. We can usually find something in there that you probably don't need. One tip I would have for you is that to prevent that from happening, because it happens to everybody all the time, because we just get so busy, is putting software on a kind of like basically a prepaid card, so that that after a year, the prepaid card is going to run out of money, and you've got the software will also run out of money. So then you have to make a hard decision: do we renew it or not? And if we renew it, then we slide it on another card, or we actually put it to our main bank account at that point. But for brand new software, highly recommend putting it on a prepaid, just so that you don't forget you did it and you're paying $39 times 10 people for 5, 6, 7 years and realize, well, I didn't even realize I even had a subscription to that software. Or is anybody really using that anymore? You don't want to come into that situation because you just wasted a ton of money. So software, I would say, is probably the number one thing. Number two thing I would say is probably your insurance. We all love insurance, but it's probably not a bad idea to shop your insurance every couple of years to kind of see what else is out there and available, or maybe even going to a different policy within yourself. If you feel that your insurance is getting out of line and your company can't afford it, but you really need to retain it, maybe go to a different model where you're paying a specific dollar amount. And each state's going to be a little different with this, but a specific dollar amount instead of the premium. So like maybe you're paying $300-$400 towards the insurance, and then the employee picks up the difference, or something like that. It really depends on the insurance, and it also depends on the state you live in to dictate how much you can actually do. But that's something to take a look at. I like it because a lot of times then the employee can also, bear some of that burden also, and you have the feeling, because a lot of times when it comes to insurance, it's one of those compensations that people just take for granted and don't even realize that you're paying out all that money for, and it kind of brings that to light a little bit, and maybe and hopefully makes them a little more grateful if you're providing that type of a service for them. So I'd say insurance, definitely take a look at. Can you think of any others that would just kind of pop out of your head, Jamie?
No, I think the other thing is obviously, similar to what you said with insurance, is just evaluate every cost you have, going through and doing analysis of vendors you're dealing with, and making sure that they're the cheapest vendor, or that they're the right one for what you actually use them for. And so I think that's the biggest thing. And you don't need to do that 2 times a year, but I think at least once a year, every couple of years, going through and just evaluating your vendor list, making sure it makes sense with what your current service package is. And so I think that's the biggest thing is, again, for service-based businesses, that list isn't going to be that long. And so it's a really easy practice just to go through and look at who am I spending money with outside of my employees, and making sure that all of them make sense. And, especially when it comes to technology and even any services that are provided to you, the industries are changing so much that things change so quickly that a lot of times costs are cut so quickly that something you are paying $100 a month for a year ago, there's another provider out there that's doing the exact same thing for half that price, because it's a very competitive market out there when it comes to providing services. So that's the key, is just making sure you're evaluating it.
Nope, completely agree.
So I have one more question for you, but before I get to that question, I wanted to plug our email address. So we have an email address, vcfo@summitcpa.net. And I would love for our listeners to email me if you want to be a guest on the show, if you have any topics you want us to talk about, or if you just have any questions for us in general. Please email that account and reach out to Jody or I, and one of us will get back to you fairly quickly. Again, that email address is vcfo@summit, SUMMIT, So just wanted to throw that out there before I ask my last question here. So Jody, it's been a while since our last recession. The further away we get from a recession, the more people worry about it. So what are your thoughts on a recession, and how would I prepare for something like that if I really feel strongly that one is coming?
Yeah, so recessions are kind of funny because really it's a normal business cycle. So it's nothing out of the ordinary. It typically happens about once every 4.5 years. So it's one of those things that is just a regular business. It's a part of a regular business cycle. So when you pop on and you notice that, or if you pop on the news, you notice that we've been on the longest growth cycle in the history ever. I think I can't remember how what the next one would even compare to, but it's been a really great growth cycle. And then you pop on the news and you see all the different predictors saying, hey, it's going to be, we have 30% chance, 50% chance, 20% chance, 15% chance. All these really smart people that are economists that really know what they're doing, they all give different answers because they really, really don't know. But what we do know is it's going to happen. It may not happen this year. The chances of it happening in 2020 are, from my understanding, pretty low. But that chance gets greater and greater and greater as the years go on. So what's really important to know is know that, hey, it's going to happen. It's not a big deal, meaning a big deal that it doesn't last forever. Our typical recession lasts no more than 18 months. That's what the last recession did. You'll find that it's probably closer to a year is what you're really looking at, a year of really toughness. Now, with a company that's very prepared for that, it's not as huge of a deal. For companies that aren't, it's a huge, huge deal. So it's important right now while the going is good, because 2020 looks very strong, especially in the first 2 quarters. And the last year has been very strong economically. It's really important to fix all the ills that you have in your system. So if your net income is not where you need it to be, you've got to get it to where you need it to be. This is the time to do it when things are going really well. When they're not going well, it's very difficult to turn the ship around. So it's important to get that there. If you don't have cash in the bank, get cash in the bank. Build money. And the way we can do to build money is to improve that bottom line net income. And so that's really important to understand how much net income you'll need to have in order to generate the cash that you're going to need to have in your company. And we always say you want at least 10% of your annualized revenue in the bank at all times. That's for operating purposes. And that's basically comes to about 2 months worth of expenses. If you're thinking that there's going to be some economic downturn or economic issues, why not have closer to 30% in the bank? You may think that's a lot of money, but you know what? That's 6 months worth of expenses. A typical recession is only a year. You've just secured you've taken most of the risk out of your company, for recession. So if you think it's really important to have money in the bank for a recession that's going to happen eventually, don't see it happening in this next year, but going to happen eventually. This year is the time to really take advantage of it. Bring your net income to closer to 20%. Figure out what you need to do to do it. Hire consultants to come out, help you out, either long term or short term. But do not just stay at 10%, have a maxed out line of credit, and go into recession and think you're going to be okay, because more than likely you probably won't be. So it's important to build that cash, get the line of credit paid off. Oh, another thing, when I say line of credit, your line of credit should be used as a line of credit, right? So as money comes in and out, you should up and down and that sort of thing. A lot of times you'll see people, it's just line of credit is just stagnant. Don't do that. Pay the line of credit up and down. Really important, because what's going to be another key that I'm going to mention is this is the perfect time to go to the bank and get a 2-year renewable line of credit. Meaning, instead of renewing it every year like most people do, if you built a good business, ask for 2 years. And so what that means is they're not going to look at it for another 2 years instead of 1. And guess what? A recession lasts again at the most 18 months. So that recession is going to allow you to have that line of credit available during that time, if in fact you do have it and you have a zero. So it's just another cushion to have. Really important. Go to the bank now, negotiate solid lines of credit. Build cash. Those are really the big keys. And the only way you can do that, unless you've got a lot of money outside of the company that you have personally to stick in there, The only way you can do that is to improve that bottom line, improve that net income. Make sure that your minimum should be 10% if you think that's the case. It should be 15 to 20%. And you need to figure out what you need to do in order to make that happen.
No, I think it's a great point. And I've seen a lot of businesses use recessions for growth. And, if you have a lot of cash going into a recession, you can take advantage of a lot of things. One, you could find a company that didn't prepare like you and you could acquire them because you have the cash in the bank and you could grow through acquisition instead of through organic growth. And that I've seen it happen a number of times where a company's been prepared and they've had enough cash in recession to get a company at a discount. Or on the other side, a lot of vendors, like we talked about earlier, if recession hits, they're going to get desperate and they're going to be willing to give you a deal and say, hey, if you pay for the next year, we'll give you half price on this product or half price on this this service that we provide. And so a lot of times you can really use a recession to your advantage if you go into that recession prepared. So I think that's a great tip, Jody.
For sure. And I'd love to spend some time on another session or another podcast to talk specifically about the recession. Maybe we can invite a few of the CFOs in and kind of get their take on it as well.
That's a great idea. Yeah. So that's all the time we have for today. So we have another podcast coming out in 2 weeks. On this one, it's going to be kind of fun. We're going to turn the tables around and Jody's going to interview me as we talk about the a pipeline and how to prepare your pipeline, what to think about on your pipeline. So that should be a fun episode and we're looking forward to recording that one. But appreciate your time today, Jody. And hopefully listeners got a lot out of this.
Yeah. Thanks, Jamie. Appreciate it.
Enjoy this episode? Visit our website at summitcpa.net to get more tips and strategies for achieving virtual CPA success. We're here to be a resource in this ever-changing industry.